Good afternoon or good evening, depending on where you're joining us. Thank you, everyone, for joining us for this very important conversation. And we apologize for the delay in the start. My name is Brenda Combo, and I'm very privileged to be one of the board members of the Africa Trade Foundation. And I think given the delay, we'll just jump right into things. But I want to start just with a few housekeeping comments, housekeeping requests. All of your mics will be muted during the session, but please feel free to use the chat and also to use the Q&A prompt for question and answer. And if you have any IT difficulties, please reach out to our IT team. David will be happy to help. But otherwise, I'm very happy to see all of you connected. And I'm also very excited to be able to introduce our opening remarks speaker. Ms. Bindu Mulea is the Manager of Trade Finance at the Trade and Development Bank. I hand over to you. Thank you.
Thank you very much, Brenda. I hope everyone can hear me.
Yes, we can hear you.
Okay, fantastic. So thank you very much, Brenda, as earlier indicated. And it's a pleasure just to be here. Esteemed speakers, board of members, and the Secretariat of the Africa Trade Foundation, and dear participants, good afternoon again. It is my pleasure to open today's webinar on Catalysing Trade Finance for Growth. First, I wish to sincerely thank each of you for joining this online event. Today, we connect from various parts of Africa, united by our shared commitment to advancing trade and economic integration in the continent. It is inspiring to see representatives from banks, regional organizations, and businesses come together to explore a topic that is of key importance to unlock Africa's potential, that is trade finance. As we all know, trade finance encompasses techniques and instruments designed to facilitate trade transactions while safeguarding both buyers and suppliers from associated risks in international trade. Its objective is to enhance the efficiency of business transactions by addressing risks such as payment delays, quality discrepancies, and non-delivery of goods. Therefore, trade finance plays an integral or an essential role in supporting both regional and international trade. It is particularly essential in developing Africa, where trade accounts for over half of the GDP. Let me share some figures or statistics with you. In 2022, the global trade finance gap reached a staggering $2.5 trillion. That translates into a 47% increase from 2020. This trend is fueled by several factors: the ongoing impact of the COVID-19 pandemic, shifting macroeconomic conditions, which can be seen through the interest rates that have heightened, depreciation of currencies against the common traded ones, supply chain disruptions, and various geopolitical events. I do not like to be the bearer of bad news, but according to experts, the gap is likely to continue to widen. However, the trade finance market size continues to record growth. And according to the Trade Finance Global Report 2024, the trade finance market size is estimated to grow from $46.8 billion in 2023 to $49.5 billion in 2024 at a compound annual growth rate of about 5.6%. The report also indicates that the trade finance market size is expected to continue to grow to about $62.64 billion in 2028. The anticipated growth in the forecast period can be attributed to the adoption of structuring and pricing tools, expansion of emerging markets, increasing focus on sustainable trade and ESG factors, geopolitical shifts and changes in trade policies, as well as efforts to enhance supply chain resilience and risk management. Now, coming to Africa, in Africa, unmet demand for trade finance is estimated about $120 billion. Research shows that this gap affects MSMEs and women-led businesses disproportionately, holding back the African economy to achieve its full potential. So addressing the challenges in trade finance is not just about bridging a financial gap, but it is also about helping the MSMEs gain access to global trade networks. It is about boosting inclusivity as well as diversity in international trade. It is also about helping countries create jobs and reduce poverty. Now, to catalyze trade finance for growth, we need some key changes. First, it is important for businesses to get a robust understanding of the trade finance ecosystem in Africa. Many firms that could participate in trade, in fact, do not even try to secure trade finance from banks. And those who do apply often have limited understanding on the various financing requirements and their available trade finance solutions. I am glad that we have experts from the Mauritius commercial banks among us, as well as Ebnia Capital, to discuss these key topics today. Next, we need greater cooperation between local commercial banks, national DFIs, and multilateral development banks to bridge the divide between the perceived and the actual risk of providing trade finance in developing African countries. Since 2020, the World Bank Group and the Trade and Development Bank have engaged in a partnership that has allowed the bank to support transactions that are over $300 million in the various member states. And this has allowed businesses, banks, and the public sector to import and export vital commodities. I think we do need such partnership more. As a final point, I would like to emphasize the need to leverage innovative technology solutions to address Africa's trade finance gap. We have to digitize the numerous standard documents that are used in trade, not only to streamline the financing process, but also to promote trade facilitation. Digital records provide verifiable and trusted data. This facilitates risk assessment and builds between clients and financial institutions. Digitization also reduces the risk of fraud. And of course, initiatives such as the COMERSA digital retail payment system and the Pan-African payment system, settlement system are key to integrating MSMEs into digital markets and enhancing intra-African trade. I am, however, keen to hear more from the CBC and pass on the status of the implementation of these systems later today. Ladies and gentlemen, the implementation of the African Continental Free Trade Area is a unique opportunity to create the Africa that we want. Trade finance will be key to unlocking the full potential of this historic agreement. Let us work together to make this happen. Lastly, I encourage you to actively engage in today's discussions, ask questions, and explore how your organization can benefit from the trade finance mechanism that will be discussed by our speakers. Thank you again for joining this event, and I wish you a pleasant discussion and interaction. Thank you.
Thank you very much for those excellent opening remarks. Thank you for sharing with us the bad news, but also sharing the good news and some of the possibilities that exist to improve trade finance on the continent. So I will now hand over to our next speaker. We're very happy to have with us Arnaud Levasseur, who is the team leader for Global Trade Solutions at the Mauritius Commercial Bank, and he will talk about how to leverage trade solutions to enable African trade. Please go ahead.
Hi, good afternoon to everyone. I would like to thank the team of Africa Trade Foundations to really invite me today to share with you a bit about our experience. But maybe before we jump into my slides, I wanted to share with you a short video of what is our trade solutions about at MCB.
Africa is on the rise in your business operations. Whether you're importing or exporting goods, manufacturing locally or remotely, or managing cross-border invoicing, collaborating with the right partner is crucial for achieving success. Ranked first in East Africa, investment grade rated by Moody's, and with over 185 years of expertise, MCB brings you a unique perspective on the African continent. Our experienced trade teams leverage on the sophisticated Mauritius IFC with unique bilateral trade agreements with India, China and Africa, giving you a competitive edge across African markets. With our extensive network of local and international partners, unlock your trade potential and manage risks effectively. We value a solution-oriented approach to enhance our understanding of your supply chain. MCB Global Trade Solutions. Bring your business to new heights.
Thank you. So I think what was just discussed is about the potentials of African trade, and obviously about this huge gap that exists, and the why is this gap exists. And for me, I'm going to talk about, first of all, there's risk involved, and the risk in international trades could be of various, from commercial risk to late payment of debtors, country risk, economic, political, legal. We have monetary risk, market risk, legal risk, and really risks of non-delivery and market interruptions. So these risks ensure that is making it difficult for people to engage more in trades, and as such also banks. So this is why trade finance, as rightly said earlier, is helping to bridge this gap, because what the definition of ICC about supply chain finance is really a use of financing, but to risk mitigation practices and technique to really optimize the management of working capital and liquidity invested in the supply chain. So the idea today is, I'm not going to bore you with a lot of technical terms, but really how can we use the supply chains and use it to help get access to finance. So this is the part, if you see the drawing on top,
then I'll be going out on a meeting.
Sorry, if you can mute yourself. So it's more about understanding the supply chain of a client. So the shipments, where is the goods going from one point to another? How long is it taking for you to get payments? And then we, as bankers, and try to understand these supply chains. And by understanding it, we are able to bridge and propose to you funding and financing adequate to your business. This is where we can leverage on different type of instruments. I don't know if you know about these, but these are marvelous instruments in trade, which is called letters of credit, bank guarantees, trade payables financing, and trade receivable financings. The reason why I'm saying these instruments are very interesting is because you're able to bridge the risks that I've just told you about. So just imagine, for instance, that you need to import from Asia. The Asian supplier does not know you. And given that you're coming maybe from a risky country, I'll give you an example, Madagascar, the first thing that they're going to do, and it's quite logic, that you will say, I want to secure my payment if I'm receiving an order from someone from Madagascar. So it's normal that you will ask for down payment. But is there other solutions for you to bridge it? So if I take, for example, a seller from Mauritius who's selling to someone in Madagascar, the first risk he's going to look at is a risk of default of payment. How can I mitigate this risk? But the buyer in Madagascar itself, he's looking at the risk of non-performance. What if the seller does not send me the goods? What can I do? So this is where, I don't know if you've seen it, it's what's called the trade risk ladder. On top of it, first, it's the one which many people knows, and a lot of you use it every day in your daily lives. If you make any payment online, or you buy something from Amazon, you're making advance payments. What you're in fact doing is you're paying Amazon first, and then you're going to get the goods, because you're comfortable with the risk of non-performance, meaning that what if something happens, you know who you're paying, so you said, I'll get my money back. So this is more the approach, which is really, really no risk for the seller because he gets the funds first, but very high risk for the buyer. On the other hand, it's something different when now the buyer is getting credit. So in some places, for instance, if you're a company in Europe, you might get credit from your suppliers. That means that for you, it's really low risk because you get to get the goods first. And once you get the goods, you get to sell it, get money, and then pay to the seller. Then it is really high risk to the seller. So you can imagine if we remain between these two, it's really where the trade finance gap now starts, because one party is not going to deal with the other because of the risk involved. So this is where you have products like letters of credit that comes into play. A letters of credit is what we call an unfunded facility. It's really an irrevocable undertaking by a bank telling to the seller, if you meet these conditions, documentary conditions, we are guaranteeing payment to you. This is why it is opened by the buyer. The buyer set all the standards and the conditions that will fall into the documentary credit. And if the seller is able to prove through documents, which is under the UCP 600 rules of ICC, you're able to get payment. So this is where we're able to bridge this issue of risk of non-performance and risk of default of payment. So the seller will in fact be taking the risk of a bank. Why report confirmed letters of credit? Confirmation means that you can seek another bank. Again, if I give an example, I said earlier, if a buyer is in Madagascar and he's using a bank in Madagascar and the seller is not comfortable with it, he can now ask another bank to confirm it. I will be very happy if he asks MCB to confirm it. We'll be glad to confirm CLC for them, and then the risk will now become an MCB risk. We have also unconfirmed LCs. So this is now when you're opening an LC with MCB, we ask our client, no need to ask for confirmations because MCB, being investment grade, provides sufficient comfort to suppliers on the risk of MCB. Then you have other product that's called documentary collection nuisance, documentary collection site, and aval. These are all the products that are in the middle that try to bridge this gap. I'm not going to go into a lot of details about these because of a timing issue, but I will gladly take any questions or afterwards if you want. So I wanted also to share with you how we are promoting African trade. We are promoting African trade by pushing our clients to leverage on our trade portal to seek opportunities. Opportunities may be from a seller's perspective or buyer's perspective. What that means that you might, by using our platform, and if you're a client of MCB, you get access to a full platform, you're able to leverage to see new opportunities in terms of selling to Africa, or if you're buying from Asia, how could we now leverage on our African counterparts and see if they are selling these products and we can buy from them. So I'm just going to share with you the website and give you an example, which I did yesterday for a particular client of ours. And you can see how this is going to help your business. So it's very simple, trade.mu. And if you go on this platform, my client was into animal feed. So under the product, he put animal feed. And you will see the HS code of animal feed. He was using HS code 2309. And I'm saying, but can you look for business into Africa? So then he's going to export to, so he's selling. Then he could put all countries, but I said, let's look at the African continent. And he put Africa. And by clicking search, this platform is telling him what are the countries in Africa that is buying this HS code. So this is where there is potential for sales. You see, and when we were looking at it, we found, very interesting that Ghana is buying for $41.7 million of this product. So we click on it, and when we click on Ghana, we now see, is Ghana importing from Mauritius? 0. Where is it importing from? Oh, Belgium, Brazil, Netherlands, South Africa, United States. Oh, interesting. We can find market reports, international trade shows, and what is interesting is 87 businesses that are buying, and you can identify them through this platform. This means it's a really great way to find opportunities, sales opportunities. But not only that, it also provides you what are the import controls that exist in Ghana? What are the export controls from Mauritius to Ghana? What are the custom duties and taxes? It will take into considerations as well around all the free trade agreements that we've signed, and what are the shipping documents that you need, calculating what could be the selling price in country. And this, it's really enabling our client to find opportunities. And I was telling you about selling, but what if we went on buying now? I said, now import from, and is there ways that he could now buy maybe some of the raw materials for animal feeds? Again, which are the countries that are selling, exporting? Egypt, Zambia, $17.1 million. So interesting, where is Zambia selling to? So and you see that Zambia is selling to Uganda, Tanzania, Zimbabwe, Rwanda. And this I'm very happy, because that means it's intra-African trade that is being promoted here. So through this platform, we are helping our client to find new opportunities and new also supply side policies. I'm saying suppliers to really diversify the suppliers base. I'll go back to my slide. So what we do, in fact, is for us, when we talk about trade finance, there is no one solution fits all.
Sorry, Arno, you seem to have been muted.
Sorry.
Okay.
Yeah. So we need to understand the supplier's side of our client, so trade payables, and then the selling side of our client, trade receivables. And by understanding these, by understanding the number of days, by understanding how from one order you convert it into cash, this is where we can position supply chain finance. Because supply chain finance, we will see how are you securing your firm order. For instance, the client would say, oh, I have this order from a buyer, I need to buy, I need money to buy, how can you help me? But the first thing is, I will ask him, what if a buyer now cancels the order? What do you do? If you're buying, who can you sell it to? So these are the questions. That's why we talk about secure your firm order. Have you leveraged on trade instrument to secure it? Have you received a letter of credit, for instance? Have you received maybe a minimum down payment? Have you received an SBLC, for instance? These are the questions that we will ask to a client, because once we are able to secure the firm order, obviously this is where we want to buy. And on buying side, we'll say, can you try to negotiate as much as possible for unfunded facilities with longer term? That means that you're able to buy, to get the goods, sell it, get the funds and pay. By being able to know this is where you're going to reduce your costs. Just to tell you, major traders in the world do this. It's not rocket science. It's sometimes just a question of negotiating with your suppliers and your buyers. Again, clients tell me, but I've been working with him so long, it's difficult, this is their policies. This is why through the trade portal, you need to have a plan B and plan C. It's always good to ask. Never know what the answer will be. So now, one of the objectives, and this is something quite sophisticated, but I'm just going to share with you how we can also do structured supply chain finance. This perspective, what that means that whenever a client has a big firm order and the financials of a client is not strong enough for us to leverage to provide financing, we can explore other avenues by trying to transfer as many risks possible from the borrower. So again, how are you securing your buyer? Do you have the right insurance, marine insurance in place? How are you covering your logistics? What are the goods? What are the underlying goods? We'll rely on the structure. We'll try to leverage on various instruments that exist around these transactions. This allowed us to give you access in a more structured, what we call self-liquidating manner, relying less on the balance sheet. This enables the banks to do what we call a one-off type of financing transactions. It obviously enables the business to expand, to enter new markets through ring fencing and robust operational and financial controls. It's really very important for us that the client is on top of their games, and obviously this reinforces the bank to client relationship because it's quite innovative, and we can do it for clients that know their business very well, for which we have a very good track record. So from a traditional perspective, traditional trade finance rely a lot on financial reports. We look at what we call repayment capacity, adequate guarantees, but a more structured one is more looking at the performance of company and its transactions. And this is where we can do self-liquidating type of financing. So something that we've been working quite a lot is how we help client business traders to deal with agent suppliers that looks for terms of payment of 50% upfront and 50% prior to shipment. So the client, the entity in Mauritius is selling to clients in Madagascar and requires credit facility of 150 days. He comes to MCB and requests to finance the deal. The order is for $1.5 million with credit of 150 days. It's a strong group in Madagascar. The suppliers require down payment. So my question to you now, are you willing to finance such deal? Maybe just by a raise of hand. I'm not saying it, but who would have financed such deals? Or do you think it's financeable? How will you mitigate these risks? So for us, again, I need to understand who the entity in Mauritius is, who are the suppliers, are they reputable in the market, the goods, the performance, know about the target client in Madagascar, how strong they are, and ask our client, for instance, okay, why don't you ask if they are that strong in Madagascar and they have a good bank, why don't you ask a standby letter of credit? By having a standby letter of credit, that means that the order itself is firm, is confirmed. If it's firm and so there's a backing of this bank behind it, we can now leverage on this instrument and enable the company to have access to finance and place an order with suppliers. On this hand, we're going to try to propose to the entity, try to negotiate as far as possible letters of credit, 180 days. That means you can get the funds, you can sell, get the funds, and then pay. Just take note that the letters of credit in general for 180 days at MCB standard pricing should cost you around 1.25%. Not mistaken. Yeah. So now, instead of leveraging for a loan that might cost you around 8 to 9%, you're really saving a lot of money. Then the suppliers will ship the goods, they will send documents, and once they send documents, the Mauritian entity is going to send documents under documentary collections to get paid by the buyer in Madagascar. We, MCB, have a possibility to finance the suppliers as well. Instead of them waiting for 180 days, we can ask them if they want a discounting. And then because there will be a timing issue in terms of a payment, we're going to request the clients to discount the receivables on the selling leg. We pay our letters of credit, and then at maturity, we get paid. So this is what I was just telling you a bit earlier, how we ring-fence these transactions. These are things that we do quite often, but sometimes not everyone is thinking about these structures, these solutions. So it's a question of approaching your banker, talking to them, and seeing how we can engage and help. I hope I was on time, and normally I take longer than this to do presentations. So if there's any questions.
All right, thank you very much. Thank you for a very clear and accessible presentation. Trade finance can often be quite a complicated and technical thing, as you've said, but I really appreciate how you used the case study and helped us think practically through some of the solutions. So thank you very much. I will now hand over to Mr. Ibrahim Malek, who is a partner at Abonia Capital. and he will be speaking about trade finance, the landscape in Africa. Please go ahead. Although we cannot
good
see
afternoon,
you.
Good morning, everyone. I'm sorry.
Okay.
Yeah, I'm sorry. I don't know why I can't put my camera on, but that's not too bad for you guys. So you'll have to bear with my voice only. Thank you for having me on this webinar, and we'll try to very quickly go through a few slides that I prepared, and just to follow up on the elements that Arno has has presented in detail. I think that one of the things that we all agree on is that there's a huge gap, and can you see the presentation, or is it online?
It is not showing yet, but I think the IT team is trying to put it up.
Well, yeah, they're putting it online. So just a quick one. I think we all agree on the fact that there is a huge gap in trade finance requirements and flows globally and in Africa, and it's been quantified to just over $100 billion, which just shows what the leakages are in terms of what African traders could do if they had access to a bit more funding. Now, and as Arno has rightfully said, the solutions are here. I mean, we don't lack banks in Africa. We don't lack funders in Africa. We don't lack solutions in Africa. And the question that has to be asked is, why don't our traders get access to that? If we could go to the first slide, please, Smita. I'm sorry, I don't control this. So the real question is that with banks like MCB, with the big South African, Nigerian, Kenyan, and the banks across the continent from Egypt downwards, they all have solutions that be traditional trade solutions or structured trade solutions and products that should be here to facilitate trade. And Arno has done an excellent job in showing us what these are, from open account to letters of credit and what have you not. But the issue remains that our traders, especially our SMEs and MMEs, are still lacking in the ability to get these solutions and to drive trade through these solutions. Now, I don't think there's anyone to blame here. It's just the fact that there seems to be a disconnect between the parties involved. And I think this is what I'm going to try focus on. I mean, having worked in banking myself for a number of years and in trade finance in the Middle East and in Africa, and now being on the other side of the fence working with clients, we realize, you come to realize the importance of, and I'd like to focus on small and medium enterprises. That means the SMEs and MMEs of this world who really drive transactions across most parts of the world, and particularly in Africa. And if you look at statistics, just one statistic very rapidly, in Mauritius, about 40% of our GDP and about 40% of our employment is made up by SMEs and MMEs. And on the continent, it could rise to 60 to 70%. So this segment in our various economies is crucial to the overall growth of each of our countries and to Africa generally. So if we do not provide them with the right solutions to fuel their growth, Africa at large will suffer. And this is where these obstacles are hurting us massively. Now, trade finance has existed forever. I mean, so it's one of the modern banking was formed on the basis of promissory notes from one country to the next. So trade finance has driven banking for centuries. And we are in a state where we have the solutions, but we cannot connect the dots. And this, I think, is a major issue we find. And once again, there seems, you will see on the other slides once I get there seems to be I wouldn't say a disconnect, but there seems to be an overlap between the providers of trade finance solutions and the people who are the recipients, and the main reason being some kind of market information asymmetry where the information is not flowing. Arno was quite clear on saying how MCB approached the clients, and most banks do that by looking at the supply chain and asking the right questions. And sometimes I think for the people who are the recipients and who are in need of trade finance, they do not understand what information to put forward. And this is one of the big flaws in our system. So the main issue we have across Africa, and I've also seen this in other parts of the world, in the Middle East, in Europe, where I've worked in trade finance and in multilateral banks, is that there seems to be a disconnect of what the bankers or what the funders are looking for and what the recipients or the borrowers provide. So it's sometimes sort of a lost in translation situation where it's a mismatch of information. I think this would be the first thing that would have to be attacked. So when companies, be it the small, medium, or big companies, do not get access to trade finance, the impact on the local economy is quite large, given the importance of these entrepreneurs in their respective economies. And it's not only a question of a company not getting access to trade finance and not being able to make profit at micro level, but the impact on the social and economic impact in terms of job creation, in terms of trans-border flows, in terms of how we can help grow the wide economy and create employment is quite huge. And one statistic that that comes from the ICC, or if I'm not mistaken, either the ICC or the International Forfeiting and Trade Agreement, is that about 80% of rejections in terms of trade finance applications come from SMEs and middle market companies, and there must be a reason to this. So this is where trade finance, the importance of trade finance is well known, and I think is accepted by everyone here in terms of a driver for prosperity and growth within the African continent. But at the same time, we have to see why there are obstacles and why there is still this huge trade gap. Because year after year, decade after decade, if we looked at the trade gap in 2010 or 2000, I can assure you, it wouldn't be much different to what it is today in terms of the GDPs of Africa. So in terms of percentage, we're still having the same issue, and this is globally. So I don't think we can only blame Africa, but we still have the same issue, and we don't seem to be able to solve this issue going forward, despite the fact that banks and other funders have a wide array of trade solutions and trade products that can facilitate and bridge this gap. If we could just move on to the next slide, please, Smita. Now, I'm going to try to very quickly, once again, Arno has given a very overall presentation in terms of what banks can provide as solutions, and it was extremely useful to see that products and solutions are not lacking in Africa. That's not the issue. I think we have trade financiers in Africa through banks and in other non-bank financial institutions that understand trade finance very, very well, and that can talk to the people who are in need and provide solutions. Now, where are the obstacles? And having been in banking previously, one of the things that I have seen and that I see clients being as one of the main obstacles to clients comes from the fact that banks themselves are now more and more constrained, especially since the financial crisis of 2008, from the Basel III requirements. And for those of you who have followed, a few years ago, a couple of years ago, there was even talk, I don't know if it's still live, but there was talk of Basel trying to increase the risk-weighted assets and that pertain to trade transactions. For example, just to get a bit technical, a site LC hits a bank for about 20% in terms of risk-weighted capital. Now they were trying to increase that. What would that mean? That would mean that for every LC that the bank issued, they would have to block more capital. What would that mean? That it would be more riskier to the bank to provide such solutions to clients, and that they would have to provide a higher pricing. Thank God it hasn't happened, but given the world we live in and given the increasing importance that everyone gives to risk and various forms of risk, this will not only impact the SMEs and MMEs and large corporates of this world, but that means that the African entrepreneur, for him or for her, to be able to put their position better and to get financing, they have to understand this. And this is a huge, huge, huge discrepancy that exists where the trader, the entrepreneur, understands its business, but doesn't necessarily understand what the bank expects from them, because the bank is operating under very, very strict parameters. And I think this has sort of reduced the facility and the ability of banks to provide, even though they are very, very keen to provide trade and working capital solutions, trade finance solutions. It's not always easy given the parameters, especially the increasing capital adequacy ratios that they operate under, and to entrepreneurs. And you have other risk elements that I will not bore with you today. But the other thing that has become increasingly problematic over the past couple of years is everything that relates to KYC and AML. And once again, it's difficult to, from a banking perspective, sitting in a bank, it's difficult for the bank to understand that, the trader will comprehend the fact that there are tedious KYC and onboarding requirements, and that there's continuous AML checks from the start during the transactions over and under invoicing, and that the bank and the financier, the funder, is under strict guidelines not to override these parameters, because basically their banking license is at risk. And for those who have worked in international banking, all the big international banks, myself having been at HSBC when we were under deferred prosecution agreement by the Department of Justice in the United States, HSBC, amongst others, were fined billions, not millions, billions of dollars for having failed in AML and other compliance, anti-terrorist checks, etc. So the risks for a bank is huge. And obviously, this impacts the way the banks deal with clients and the way the banks or other funders deals with trade finance solution, because trade finance is one of the highest risk in terms of cross-currency and AML flows. And I think entrepreneurs have to be made aware of, when they approach banks, they know their risk. Arnaud has talked in depth about non-payment risk, but there are other risks that probably the traders in Africa do not understand. And when they go to banks, they think the banks are just trying to make life difficult for them. They don't realize that if the banks don't ask the right questions, they could lose their Nostro account in the US or in Europe, or they could lose their banking license, which was the case with the likes with HSBC, with Standard Chartered, with the BNP, who were fined billions, once again, billions of dollars. All this is online. Anyone interested can go on the Department of Justice website. It's quite interesting read, and to see what the risk they're taking. Now, I think I just wanted to make this point, because more and more we're seeing sanctions and KYC and AML being used as I would say, a weaponization by the international banks to do or not to do business. The reality is that in certain countries, correspondent banks have just moved out of the continent, of the African continent, because compliance costs have increased so much. I mean, once again, I'll give my example. At HSBC, during about 10 years ago, 2012, 2013, we pretty much exited many relationships we had in Africa and concentrated on a few because of compliance costs. Now, got nothing to do with credit risk or whatever. It just is how the banks value where they're going to put their risk-weighted assets. So all this, from a bank point of view, and I'm not making a case for banks here, but entrepreneurs have to understand where they're coming from and what information and why banks refuse them. So this has sort of reduced the ability of banks, even willing banks, to provide trade finance in across sub-Saharan Africa. Now, the other live, and this is I'm sure most of you in Africa or who deal with the African continent will understand, is the access to hard currency. I've used dollar liquidity as a proxy to that. In Mauritius, I mean, Arnaud will agree with me. We've never seen this in Mauritius since 2020, 2021. We've never seen the situation where we are struggling week after week to access dollar liquidity. And Mauritius is an international finance corporation, a financial center. So basically, we've always had access. We have no exchange control in Mauritius. But despite that, getting access to hard currency, especially US dollars, is becoming a challenge. And probably not as much as certain other countries on the continent, but for us, it's a new thing, and we weren't used to that. And this is one of the main issues that traders are facing in Mauritius today. And I get requests from companies based out of Kenya, based out of other parts of East Africa, coming to me and asking me, can we have facilities for our trade in Mauritius? And when I ask them why, and the answer is very simple. Either our commercial banks in Kenya or wherever else don't have access to dollar liquidity, or it's at a very high price. So I think one of the big issues we have as a continent, and we hope that the various solutions that are being provided and will be provided by the Africa Continental Free Trade Agreement and other platforms, is that we'll have to move away slowly from bilateral trading in US dollars. And there's no other solution. Already, when Mauritian exporters of textiles sell to South Africa, they sell in rand. Now, it's easier and it facilitates the flows. Mauritius has just signed a swap agreement with the Central Bank of China to encourage trade between in rupees and in RMB. So these are solutions and that we have to look at as a continent to facilitate, to remove the main strict parameters that African entrepreneurs who probably don't understand this, and I'm not saying this in a bad way, because it's not their main concern. Their main concern is to trade. And all the other players within the ecosystem have to make sure that the environment makes it easy for them to trade. So one statistic that the IMF put forward, which was shocking, was that corresponding banking relations have declined by 20% since 2011. So 1/5 of the banking relationships, especially Western OECD-based banks, have exited Africa, either physically or with bank lines. And I can safely say the likes of HSBC have moved out, BNP are moving out, Standard Chartered are reducing. So the access, what does that mean? Where do we get our dollars from? Now, thank God we've got big banks, be it the MCB or the banks, who are still trying their best to provide dollar liquidity, and they have to go on the market to get it. But it reduces the ability of our trade guys, our trade entrepreneurs, to get access to these dollars, to be able to buy their imports and service their customers. Now, this is a structural issue. So you have a situation where you have an ecosystem where traders are just dying to do their job, but they can't, for lack of dollars or lack of euros, to access their imports. Now, obviously, there are unfunded solutions, and we'll come to that, but it's not always easy, and it's not always applicable for the smaller entities to get access to that for various reasons, amongst other credit risks. Now, I didn't want to start on a negative note, but I just wanted you to understand the constraints that even providers of trade finance are facing when trying to help the entrepreneurs. If we can move on to the next slide, please.
Sorry to interrupt, Ibrahim, could you wrap up in just a couple minutes?
Sure.
Okay.
I think the solutions, and this is what the next 2 or 3 slides are about, the solutions are how do we get the trade guys, the trade companies, the traders in Africa to access funding. And I think there's a huge job to be done in terms of financial literacy and business documentation, in terms of bringing them at par to what funders, banks, etc. Need in terms of providing solutions. Now, there's a huge issue going on, and there are huge solutions being provided. I read recently that the Merchant Chamber of Commerce, for example, with the UNDP, has created a setup called Export Accelerator, where they encourage merchant SMEs to join them on a capacity building to be able to market their solutions to the African Free Trade Agreement region. And this is what we have to do. We have to train entrepreneurs on what it takes and how you present your requests to get access to trade finance. They have good businesses. We should always try to differentiate between what is the perceived risk in Africa to what the real risks are. And very often perceived risks are very much higher just because of a lack of information. So that's one thing where I think there must be a huge push towards trying to democratize the requirements that banks and funders provide. And I think very quickly, now with increased inclusion of ESG parameters, it will make life even more difficult for the participants. So this too, we need to see how ESG parameters are tuned to what Africans and what the African continents need. And I think on the last 2 slides, what I've tried to do is try to see commercial banks and the traditional banks are where funders have gone. I think it's important that there is an education to companies who need trade finance, that they can also approach non-bank financial institutions, trade funds, debt funds. There are many of them in Africa where discussions can be had, where there could be hybrid solutions. And I mean, banks will always be the main drivers of trade, but you should not look at other solutions which could facilitate trade finance and also help companies get access to funds and get access to money that could help them trade. Just to finish very quickly, basically the solutions are here, but there are lots of issues. How do you bridge that gap? That for me is a communication exercise where the SMEs and MMEs have to be made aware and shouldn't be scared to talk to banks and should be scared to understand what are the requirements. And on the other side, the funders should realize what the SMEs need and what they can provide or not. It's not always easy to get an SBLC. It's not always easy to get hard currency and hard security collateral. I mean, it's a debate that we'll still be talking about in 10 years, but unless there's a connection and unless there's a willingness on both parties to try to bridge that gap, we are not going to see a reduction in the trade gap, and that will be that would be a tragedy for the wider continent. So very quickly, this is, if there's any question I can take afterwards, but this is what I wanted to talk about. Thank you very much.
All right. Thank you very much. And sorry again for having interrupted you. I really appreciated your framing of, what you've put as this problem of mistranslation between the providers of trade finance solutions and its recipients. And so it's interesting to think through how how they could end up speaking the same language. So thank you very much for that. that presentation. I will now hand over to Dr. Jonathan Pinifolo, the Chief Operating Officer within the DFI program at the COMESA Business Council.
Nice. And I don't know, in the interest of time, how many minutes do I have? Just to be sure.
If you can do it in 10, that would be great, but we can give you some allowance.
Okay, 10 minutes, I'll try to push. Okay, so in the case of COMESA, trying to come up with a regional payment system. And what we are basically doing is to solve the challenges which MSMEs are facing. So in terms of the challenges, our MSMEs do have issues like, for instance, payments. When it comes to payments, it takes a lot of time, like it's not real time. But also there are even other issues to do with market intelligence. Like, for instance, where do they get their market information from? So I think this is a slide that is common to everyone. In terms of cross-border challenges, our MSMEs do face a number of challenges when it comes to payments, like, for instance, currency exchange risk, but also, above all, the most important aspect is the high transaction cost. So essentially, for our project, what we are doing is we want to cover all the 21 COMESA countries, and our key focus is on the 8 pilot countries. So we have Zambia, Malawi, Kenya, Uganda, Rwanda, Egypt, Ethiopia, and Mauritius. In terms of the choice of the countries, it was basically focused on the trading corridors. Like, for instance, if you look at Southern Africa, Zambia and Malawi, there's a trading corridor. We also have to look at countries in East Africa, like, for instance, Uganda, Kenya, and Rwanda, and the North Africa, but also we have to look at Mauritius. As for our expected outcome, we are looking at issues like, for instance, enhanced financial inclusion, but also, above all, based on what the previous speakers have highlighted, is to do with SMEs. How do they participate in both national, regional, as well as even global supply chains? So by the end of the day, what we are trying to focus on is to say, want to increase inter-trade in the COMESA region, which is actually very low, around less than 20%. So in terms of our design, we are doing our design based on what we are calling the level 1 design principles. So our key focus is on the MSMEs, who are the bottom of the financial pyramid. And I think it's also well known to everyone that when it comes to transactions, these MSMEs at the bottom of the pyramid, they don't want to have like high costs of transactions. So we're trying to use really low cost of transactions. And we are also looking at even other aspects, like, for instance, use of appropriate technology, because also some of them don't have even the required education that can assist them to make transaction and other aspects. At a bigger picture, this is the architecture. So we sort of like want to connect all the commercial banks, but also the non-banks, such as mobile network operators, as well as even going up to the agent level. And once we've done that, I think our main purpose is to have inclusive instant payment platforms whereby payments can be done instantly. The other aspect is about the building blocks. So we do have all the building blocks, like, for instance, in the case of stakeholder commitments, according to the heads of states in the COMESA region, they already endorsed the program, but also we're going to have oversight by the COMESA Committee of Central Bank Governors, and we'll also be looking at other aspects which the previous speakers have talked about, e.g., anti-money laundering, combating financing of terrorism, but also even aspects to do with KYC. So what is more critical is on the value proposition. So this is a value proposition that we are looking at. So number one is the local currency approach. I think the previous speaker talked about access to, like, for instance, US dollars. So what we're trying to say is when it comes to transactions, they have to be done using local currencies. That's number one. But also, secondly, we are looking at the aspect of affordability. They have to be affordable. And also, we are looking at inclusive instant payment. So by the end of the day, when one is probably making a payment, we don't want, maybe when it comes to settlement, maybe T+1, T+2 settlement, whereby it will take maybe a day or two for settlement to be done. Because when you look at these MSMEs, they want their payments to be done there and then. But also, we've been building capacity of the MSMEs just to ensure that they are well prepared for the market, they are aware. And also the other important aspect is about interoperability. So we're looking at having interoperability with other existing systems, be it the SADC TCIB, PAPS, whatever systems that are there, and also even the wide geographical reach. So in essence, what we're saying is, let's say for an agent, let's say in the case where mobile money is being used, one can still leave money cash at an agent and make transfers to another country, because cash still remains king, will not be 100% eliminated from the word go. But also, going forward, we are looking at aspects like, for instance, market intelligence, whereby we want to have an e-commerce platform. So with this e-commerce platform, our traders will be able to check information, market information, like, for instance, maybe if one is in Zambia, you can check what sort of cheaper products can they access, maybe in Egypt or Uganda, maybe cheaper fertilizer, or Mauritius or any other country. So once they are satisfied, they can pay through the platform or use other means. We are also looking at other aspects, like, for instance, security. We are aware that systems are planned to be attacked. Today, cybersecurity is of key concern. So our system, we have like a fraud management component that is also using artificial intelligence, AI, to detect fraud. Other issues include, like, for instance, access to finance. What we noted also, like when we did our studies, we noted to say that like almost 13% of our MSMEs do have challenges when it comes to access to finance. We have achieved quite some a lot of achievements. So of key importance that I would like to share is the proof of concept. So we did the proof of concept between Malawi and Zambia. And with this proof of concept, we indeed validated to say this platform is indeed viable, the system itself, and traders will be able to send money from one country into the other country. So as of now, we are almost at the implementation stage, and we have got already a vendor who is on ground doing some work, and we are looking at probably maybe end of the year or next year where the platform is going to be up and running. As for the focus areas going forward in terms of our project, so these are the key focus areas. So number one, currently we are focusing on the regional payments platform. And then also we've been doing some capacity building programs and awareness. So in all the 8 pilot countries we've finished, including Tunisia, but also we are looking at some policy framework aspects. And going forward, we'll be looking at e-commerce and logistics, because by the end of the day, payments can be done, but we also have to look at the whole trade ecosystem. So in a nutshell, these are some of the like the capacity building programs that we've been imparting on the traders, like for instance, digital platforms, financial literacy, e-commerce, business management, and the like. So the whole aim is just to make sure that these traders are also equipped with other skills over and above the digital platforms. So basically, I've tried to be very, very fast. That's in brief about what we are doing in COMESA. Thank you very much.
Thank you very much, Jonathan, and thank you for being very efficient with the time. We really appreciate this update, this introduction and update to the digital payments platform. I will now turn to Mr. John Bosco Sebabi, who is the Deputy Chief Executive Officer at the Pan-African Payment and Settlement System.
Thank you very much, MC, and maybe can I be good afternoon all?
Good afternoon.
Can I be given the right to share my slides, or somebody wants to put them up for me, but I always prefer to manage it myself.
Okay, I think the IT team will see what they can do.
Thank you. But in the meantime, let me thank you for organizing this this forum, and also inviting PAPS to be able to be part of it, so that we can brainstorm and see how we bring in payments and trade, and particularly how PAPS is supporting the implementation of the me to share on my own.
I don't think it's possible. Is it okay if Smita shares it on your behalf? Okay, thank you.
Fine, it's okay. I'll look at it. Maybe please straight away, in the interest of time, go the first slide so that I can dive into into the main slides. So what is when we talk about PAPS, what do we mean? PAPS is the Pan-African Payment and Settlement System. This is at the advent or the creation and the signing of the agreement of the ACFTA, which is a single continental market for goods and services, to be able to free the movement of business people, investments, and accelerate the establishment of the Pan-African Economic Community, talk of. So now, at the signing of the agreement in 2018, and also the launch of the ACFTA Secretariat and its implementation to start it off, the heads of state and mandated the African Export-Import Bank and the ACFTA Secretariat, together with the AU Commission, to implement a payment system. And the mission of the ACFTA is to bring together 55 states, which is a huge market of $1.2 billion, a billion people, and more than 22.5 trillion USD in terms of GDP. So the intention is that this cannot be implemented without an accompanying payment infrastructure. Please, the next slide. So this constitutes the whole. Now, Afrexim Bank supporting the ACFTA's implementation means that among the initiatives that were created to support the 4 pillars of the ACFTA, I'll come back to them, but perhaps is one of the critical steps to facilitate intra-African trade. And so in July of 2019, the heads of state mandated Afrexim Bank and adopted PAPS as the cross-border payment system throughout Africa. Now, as he puts up the third slide, this did not mean that we are going away with the regional payment systems. What means that PAPS comes in to support them and make them interoperable. For instance, how does COMESA communicate with the Maghreb region? So this is the intention and this is the objective of PAPS, to be able to make the regional payment systems interoperable. So and why Afrexim Bank? What's the unique advantage and support that Afrexim Bank gives to the payment system? One, Afrexim Bank is a settlement bank, and by that nature, it supports and settlement agents to mitigate the settlement risk. In payments, there are 2 critical risks. That's the settlement risk and the operations risk. That means if the system goes down in terms of its availability, but also in terms of settlement agents if they're not able to settle, because a payment is only complete when settlement occurs. So Afrexim Bank avails the credit facilities for settlement agents to be able to settle in case they don't have the facilities at that moment. And also the Afrexim Bank developed the infrastructure, and also Afrexim Bank has in total put what we call the digital ecosystem to support intra-African trade. So we have Mansa, which is the KYC platform. We have the African Trade Gateway, which constitutes several portals where we can have trade information, where we can have regulatory information, and then perhaps that's a payment trail, which crowns it all. Next slide, please. Now, what are the issues around cross-border payment systems in Africa? Globally, there are 4 challenges of payment systems. One, cross-border payment systems. We have the issue of high cost, inaccessibility, lack of transparency, and speed. So, and in Africa particularly, we add in 4 that we have fragmented regional payment systems. That means of the 8 blocks, 4 of them have regional payment systems. But the regional payment system must talk to each other. They are today working in silos or in regions where they operate. That's where they stick. So we need to have these working together and interoperability. So there's a problem of interoperability in African cross-border payment systems. The third is that we depend a lot on the foreign currency. That means we use foreign currencies in every trade transaction and any payment that we do across the borders. So what PAPS aims is to have part of that trade done in local currencies. And once the trade is aligned between countries, then can be purely done in local currencies. But where there's a balance, where there's a gap in terms of trade between 2 currencies, then the settlement of the net can happen in USD or in Euro. However, we strive as much as possible to do the payments into any local currencies. And certainly we have this length and cost of the correspondent banking system. If you recall, about 7 years ago, most of the banks in Africa were closed out of the correspondent banking system because of the stringent KYC requirements. So this is this kind of correspondent banking system becomes a huge hindrance for trade because not all our banks can access a correspondent bank. Many of them have go through the African bigger banks. So that creates another layer which creates inaccessibility, which creates increases the time when the payment can be made and also increases the cost of it. Next slide, please. So how about PAPS? PAPS is the financial market infrastructure for the economic and financial integration of Africa. Now, it's a centralized payment and settlement system to be able to effect payments efficiently for intra-African trade, but also for remittances and e-commerce. So it majorly uses local currencies, but as I said, because there are imbalances in trade between countries. And as we know, a currency, the demand for a currency is a derived demand. So for me to demand for the Malawian kwacha, I must be intending to buy a good or a service from Malawi. So because of that, then countries have trade imbalances. Some countries are trading more, are net exporters, others net importers. So once there's a net exporter to another country, that means the currency of the other countries where they export from are bound to hold those currencies in their economies, and that their traders or their economic agents are not demanding for those currencies to be able to import from the other country. So what happens is that they tend to resist trading in those currencies because largely African currencies are not convertible into each other. But with trade increasing, we find that currencies get aligned. But in the meantime, before we do that, we settle the difference, the net difference in USD or in euros, whichever currency that the parties may wish to have. Next slide, please. Now, I talked about the pillars of SFTA. These are the 4 pillars of the SFTA's implementation. And these were to support the implementation of the African Continental Free Trade Agreement or area. We have the trade finance facility for SMEs and everyone else. So, I mean, for trade to happen, there must be a trade finance facility from institutions. African Bank, of course, is always available to do that through its trade finance intermediaries that are commercial banks within certain jurisdictions or economies. We have the African Trade Gateway. I talked about it with a consortium of digital platforms for information, for goods, for trade, and for KYC. And then we have the African Adjustment Facility, SFTA. So what does this mean? It means that because to participate in a free trade agreement, countries sometimes have to reduce tariffs and stuff like that. So this sometimes strains their spending. So there's an adjustment facility to be able to cushion that, so that any loss that is incurred with the reduction of the tariffs because of the SFTA, then this facility can come up and cushion that. Then you have the Pan-African Payment and Settlement System. So all these were endorsed by the heads of state, but majorly the PAPS was endorsed by the heads of state as an implementing infrastructure for cross-border payment systems. Next step, next slide. Globally, this is how PAPS works. You have a sending bank in one economy and a recipient in another economy, where you have where the economic agent or anybody wishing to buy any goods from the other country will contact their local bank. That's a member of PAPS, of course, and this payment instruction is sent to PAPS, and PAPS carries out all the necessary validations, checks, KYC checks, everything, and the payment sent through. Once the receiving institution confirms that yes, this client is okay to receive these amounts, the institution is also verified, then the beneficiary's bank clears the funds to the beneficiary's account in local currency. At the end of the day, this is a global overview how it works. At the end of the day, the settlement agents will work, or perhaps works out a settlement report that the settlement bank will settle the banks off their settlement accounts, and the settlement bank is Afrexim Bank. So all the participants open settlement accounts within the books of Afrexim Bank. That's where settlement occurs. So for a payment to move from one bank in one country to another, normally in our agreements we say 120 seconds, but this is what we state, which is 2 minutes. However, in all the transactions we've done, we've experienced this around 10 to 12 seconds. So it's been much faster. But our aim is that a payment goes through in 2 minutes, 120 seconds. Next slide, please. So what's a value proposition that PAPS brings on board? One, it's a system owned by the African central banks or institutions, managed by an African multilateral, which is Afrexim Bank, and the governance is purely done by African central banks. So what happens, we have a structure, a governance structure. We have the PAPS Governing Council, which is constituted by the governors of member central banks, and they constitute the Governing Council. Two, we have the PSOC, which is the Payment Systems Oversight Committee, which is now constituted by the heads of payment systems in central banks to oversee the system. Central banks have in their duties to supervise and regulate payment systems, and also actually central banks have 3 roles in payment systems development. One role is they regulate the systems, they operate or own the systems or participate in the systems, and 3, they catalyze. So all these roles, and our governing council plays all those roles. So PAPS is built on international standards, ISO 20022. So I'll not go through that so much. Let me just dash, because I can say time is of the essence here. Next slide. Now, these are the benefits from PAPS. You have an instant payment system, and this is how it answers the challenge of global of cross-border payment systems globally, and also in the African continent. So it's instant, solves the challenge of speed. It's low cost, solves the challenge of price. It's a net settlement system. That means that the funds needed, the liquidity needed to go through a system is much lower than what should be necessary. And at the outset, because the net is what is paid in dollars, countries save those funds they were using for importation. It's also it's on a tiered approach. We have central banks, commercial banks, and the fintechs come in as the indirect participants. So this is how it's arranged to manage the transparency and the access challenges. Next slide. Next slide, please. Now, what's the progress so far? We have now 14 central banks that have signed. We have 11 switches. We have almost 130 commercial banks that have signed, and these are in regions: West Africa, North Africa, Eastern Africa, and Southern Africa. So we are practically everywhere in Africa. Next slide, please. The commercial bank network. And next slide. I believe I'm coming to the end now. So this is what we want to happen. We want to have all these regional payment systems connected together in one Africa. And this is our aim and our objective, to create a single African market and supports growth. Next slide, please. So ladies and gentlemen, this is my last slide, and thank you very much.
Thank you very much for that really helpful overview and update on PAPS. It's really exciting to see all of the developments that have happened just in the last few months. So we don't have very much time left, and I'm not sure if any questions have come in. Let me just liaise with Smita.
There's one question that's come in. I'm reading it. It says, from Ponam, to implement PAPS, would it be easier between all countries in Africa, peg the exchange rate against one another? Yes. Now this is related to the incompatibility between African currencies. What we realized that two things have we realized that yes, where there's no trade, currencies don't talk to each other. They're not aligned at all. But once trade picks up, most currencies tend to be aligned. If we can look at anybody has visited some kind of cross-border trading centers within two African countries, maybe between Malawi or Zambia, you always see that the locals are exchanging money without any reference to a dollar, because the trade is always, the volumes are very high. But that is an experiential kind of method. What African Bank is doing today, we are working on to create an exchange rate mechanism between African countries. And once we have achieved that exchange rate mechanism, then we will not need any third currency to be able to convert African currency into the other. So that's the economic square of doing it. That work is underway. And at the same time, we can couple that with some technologies to be able to merge and move much quicker. So that's, we are working on that to be able to have one currency convert into another to be able to achieve convertibility between African currencies.
Excellent. Thank you very much.
Thank you for the answer. That was a good insight.
All right. Thank you.
There's another question on how long will PAPs take to settle a transaction on RTGS if pegged to the dollar or euro, if that relies on correspondent bank, and how do the costs relate? PAPs doesn't use correspondent banking system. So what we do is that we have, if it's a commercial bank settlement model, the commercial bank opens an account within the books of African Bank, and the other also must be a member of PAPs. So our system connects to the core banking of the commercial bank, not to the RTGS of the country, because the RTGS is managed by the central bank. So that is how it's done, and also all the banks connect to us. So the payment is instant. The settlement is what occurs at the end of the day. So we don't have any connection with the RTGS if we are using the commercial bank settlement method. If we are using the central banks and the ones opening accounts, yes, we have a link to the RTGS, because PAPs must open kind of a mirror account in the RTGS to be able to do that transaction. So in terms of cost, it doesn't depend whether we're using RTGS or not. We have, if a central bank is not doing settlement, we have certain pricing, but and also the commercial banks certain pricing, but we keep them so low to the extent that we've been averaging maybe minimum $2 and maximum about $12.
Okay, thank you very much. I think there might have been one more question about whether Afrexim uses its Nostro account domiciled abroad for settlement. For all settlement accounts, once they're funding their settlements, yes, we use them our accounts abroad. For one reason that somebody's saying thank you already. Let me finish. So we use that, for example, bank accounts in our correspondent banks because these are in USD and euros, and these are the accounts also that are used by our settlement banks to move funds from there, wherever they are, onto their settlement accounts within the books of African Bank. Okay.
Thank you very much.
Thank you very much. Thank you to all of our speakers, and apologies again for the delay. But it's been a pleasure for me to moderate. I was stepping in for Paul Baker, who unfortunately has been traveling, and he is the founder and the chairperson of the Africa Trade Foundation. I will now hand over to another colleague who serves as the protector for the foundation. We're very lucky to be able to work with him. Switin Munyantwali is the vice chairman and the co-founder of the ILI South African Center for Excellence. He's also a senior advisor at the ABSA Group. and also, as I said, protector at the foundation. And he will close the session.
Thank you, Brenda. Really, this has been an exciting engagement. Dear speakers and participants, I really wish to thank our esteemed keynote speaker, Ms. Bezu Muleya, for her opening remarks, and our impressive panelists, Mr. Arnaud Levasseur, Mr. Ibrahim Malek, Dr. Jonathan Pinifolo, and Mr. John Bosco, who just spoke, Sevavi, for taking the time to share their experience and insights on the important topic of trade finance. Accelerating trade in goods and services both within Africa and between Africa and world markets is key to unlocking our potential. At the Africa Trade Foundation, our vision is to support the effort in moving Africa's routes to market, integration and positioning in the world from rhetoric to actions. This is because we truly believe there's still much to be done to shed light on the opportunities, better understand the market risks, and leverage the trade and investment agreements, both within the continent and outside of Africa. And there is no doubt that trade finance is at the center of our integration agenda. We have had a great presentation that has shed light on the African trade finance landscape. Developing Africa's trade faces a trade finance gap of $120 million, which is expected to widen in 2025. Increased interest rates have not only led to a rise in the cost of financing, but also increased lenders' risk aversion. This is why it is important for businesses, particularly SMEs, to understand how best to leverage trade finance solutions to grow their businesses, another topic that was covered in today's webinar. We have also heard about true transformative initiatives being developed to address the historical complexities and costs of making payments across African borders. COMESA's digital retail payments platform and the Pan-African Payment Settlement System. Both these systems are crucial to advancing financial inclusion and boosting intra-Africa trade to drive economic development across our continent. Colleagues, I hope you found this webinar as insightful and as engaging as I did. I would like to thank all participants for their engagement and interaction. Please feel free to reach out to us if you have any questions or if you'd like to collaborate with us. We have shared the Foundation's brochure in the chat box, along with the links to our dashboards, which provide up-to-date information on implementation of the AFCFTA, as well as trade and macroeconomic data for African countries. I would like to extend my gratitude to our board members, David Luke, David Luff, Teddy Subramanian, Brenda Kombo, and Caroline Kube, for their invaluable guidance and leadership. A special thanks to Vipin Bowen, our Executive Director, for his dedication. Finally, thank you to the team at the Africa Trade Foundation, particularly Ms. Neha Goindo, for putting this event together and ensuring its smooth delivery. I now declare the session closed, and I want to thank you all for your participation and engagement and wish you a very nice rest of the afternoon. Thank you.